Welcome back, everyone. We're diving into the world of ETFs again today.
Always exciting.
Definitely is. And this time we're looking at one that's really caught my eye.
Oh, which one?
It's called QDTE, the Roundhill Innovation 100 DTE Covered Call Strategy ETF. Bit of a mouthful,
Yeah, I can see why that one might need some explaining.
right? So it's all about innovation and high yield. Two things our listeners love.
Sounds promising. What's the catch? There's always a catch, right?
Well, that's what we're here to find out. QDTE claims to have a whopping 38.90% distribution rate.
Wow, that's impressive. Almost too good to be true.
Yeah, that's the question, isn't it?
Right.
We need to figure out how sustainable that is.
And what role return of capital plays in all of this.
Absolutely. So to help us break it all down, we have our expert with us today.
Happy to be here.
Thanks for joining us. Let's start with the basics. Can you explain what a covered call strategy is? In simple terms.
Sure. Think of it like renting out a property you own. You collect rent, which is like the income from the covered call.
Okay, I'm following so far.
But if the value of that property skyrockets...
Stuck with the rental agreement.
Exactly. Your gains are capped because you've already agreed to sell at a lower price.
So there's a trade-off. Income now for potentially limited gains later.
That's the core of the covered call strategy. Now, QDTE doesn't actually hold the stocks in the Innovation 100 index directly.
Really? So how does that work?
They use deep-in-the-money call options,
Deep in the money.
meaning those options are very likely to be profitable.
Almost like owning the stock itself.
Exactly. It's a way to replicate stock ownership using options.
I see. So they're playing landlord with the Innovation 100 index, but they have this really strong lease agreement instead of owning the property outright.
That's a great analogy.
Okay, so what makes QDTE stand out from other covered call ETFs? There are quite a few out there.
You're right, but QDTE focuses on zero DTE options.
The Euro DTE,
0 days to expiry.
meaning.
They sell these options every single day at the market open.
Whoa, hold on. So someone's making those decisions daily. It's not automated?
That's right. It's actively managed.
Interesting. So they capture overnight gains and avoid overnight risks?
Exactly.
Clever, but also adds another layer of complexity, doesn't it?
Definitely. Now, you might be wondering how QDTE compares to, say, QYLD, another popular covered call ETF.
Actually, that was my next question. They both seem to be in the high yield game.
They are, but QYLD focuses on the NASDAQ 100 index and pays distributions monthly.
Whereas QDTE targets the Innovation 100 and does this daily zero DTE thing.
Precisely. Different indexes, different strategies, but both aiming for high yield.
Okay, got it. So you keep mentioning this Innovation 100 index. What exactly is that?
Well, it's an index that tracks 100 of the largest U.S.-listed companies considered to be innovators in their fields.
Sounds right up our listeners' alley. They're always eager to hear about the next big thing.
Absolutely. We're talking about companies pushing boundaries in tech, healthcare, and all sorts of exciting areas.
But not just your typical established tech giants.
Not necessarily. While those might be included, the Innovation 100 Index really digs deeper to find companies disrupting industries and shaping the future.
Love that. Okay, I'm starting to see the big picture here, but let's zoom in a bit. What's actually in this ETF? You mentioned they don't directly own shares.
That's right. Their holdings are primarily those deep-in-the-money call options on the NASDAQ 100 Index, also known as NDX.
NDX, okay. And since they're so deep in the money, they basically move in tandem with the NDX.
You got it. It's like owning the index, but indirectly. And it's the setup that enables their daily zero DTE covered call strategy.
Mind blown. So can you walk us through an example of how this actually plays out in practice?
Absolutely. Let's rewind to January 3rd, 2025, just a few days ago. The NDX opened at 21,096 that morning. QDTE then sold call options on the NDX with a strike price of 21,230.
So they were essentially betting that the NDX wouldn't go above that price during the day.
Exactly. And for each of those contracts, they collected a premium of $3,788. They sold 287 contracts that day.
Hold on, let me do the math. That's like over $1 million. Just for selling options on one day.
That's the power of options trading, especially when you're dealing with an index like the NDX. But there's a flip side to this, of course.
I was just about to ask, what if the NDX had actually gone above that strike price? Would they have had to sell their holdings?
Great question. This is where things get a bit more nuanced. You see, NDX options are cash settled.
Cash settled. What does that mean?
It means that even if the calls are exercised, QDTE doesn't actually have to sell any underlying shares. They just pay out the difference between the closing price of the NDX and that strike price.
Oh, I see. So they can keep selling covered calls every day without worrying about potentially losing their position in the NDX. That's pretty smart.
It does mitigate some risk, for sure.
So they're raking in those premiums while staying invested in the index? Sounds like a win-win.
Well, not so fast. There are always trade-offs in investing. Remember that capped gains issue we discussed earlier? And those fees, almost 1%. Yeah, 0.95% to be exact. That's a pretty hefty expense ratio for an ETF.
It is. So those are definite downsides to consider.
Absolutely. And those are just the tip of the iceberg. There are other risks associated with QDT's unique strategy that we need to explore.
All right, then. Let's dive deeper into those risks and really dissect whether this high-yield potential is worth the trade-offs.
All right, so let's unpack this Innovation 100 index a bit more.
Yeah, we've talked about how WQDTE works, but now let's look at what it's actually invested in.
Right, because ultimately the performance of those companies is going to determine how well this ETF does.
Exactly. And remember, it's not directly holding these stocks, but its returns are tied to the index's performance through those deep-in-the-money options.
That's right. So are you ready to dive into the world of innovators?
Absolutely. Give me some names. What are some of the heavy hitters in this index? Is it the usual suspects like Apple and Amazon?
Well, they might be in there, but the Innovation 100 index goes beyond the usual suspects.
Okay, so who are we talking about?
Companies like Tesla, for example, they're not just about electric vehicles anymore. They're really making waves in renewable energy.
Right, they're kind of a powerhouse in that space.
And then you have companies like CRISPR Therapeutics, leading the charge in gene editing technology.
Gene editing, wow, that's getting into some serious sci-fi territory.
It is. And we can't forget about SpaceX, revolutionizing space exploration.
SpaceX, seriously, that's in the index.
It is. They're pushing boundaries in so many ways, it's hard to ignore them.
That's incredible. So I'm guessing this index is heavily skewed towards tech.
Tech is definitely a major player, but it's not just tech. We're also seeing innovation in healthcare, consumer discretionary, even industrials.
So it's a pretty diverse mix then.
It is. The common thread is that these companies are all about developing groundbreaking products or services or completely new business model.
Disruptors, basically.
Exactly. But here's the million-dollar question. How do we know these companies are going to keep growing? That's what really matters for QDTE in the long run.
Right, because innovation doesn't always translate into profits.
Unfortunately, no. And there's no crystal ball to tell us which companies will succeed.
I wish there were.
Me too. But what we can do is look at the sectors these companies operate in.
Okay, so what are we seeing there?
Well, a lot of these companies are in fields that are expected to experience significant growth in the coming years.
Like?
Artificial intelligence, cloud computing, genomics, renewable energy, these are all areas with tremendous potential.
So there's reason to be optimistic.
I'd say so, yes. But remember, investing always carries risks, especially when we're talking about innovation.
Right, because even disruptors can get disrupted.
Exactly. That's why diversification is so crucial. And the Innovation 100 Index does offer that with companies across different sectors.
Okay, that makes sense. Now, out of all these companies, are there any that you find particularly interesting or worth keeping an eye on?
One that stands out to me is Palantir Technologies. They're specialists in big data analytics and AI.
Palantir, yeah, I've heard of them. Don't they mainly work with governments and intelligence agencies?
They do. Their tech has been used in everything from counterterrorism to disaster response. They're a bit controversial, but there's no doubt they're innovative.
Controversial how?
Some people have concerns about the ethical implications of their technology, especially when it comes to privacy and surveillance.
Ah, I see. It's always a balancing act with powerful technology.
It is. But putting that aside for a moment, their track record is impressive. Remember the hunt for Osama bin Laden?
Yeah?
Their software played a key role in that operation.
Wow, that's pretty remarkable.
It is, and they're just one example. Another company I'm watching is Unity Software.
Unity Software, what do they do?
They create this platform for making and running interactive 3D content. Think video games, but it goes way beyond that.
So architecture, engineering, even filmmaking.
Exactly. And they're a big player in the metaverse.
All right, the metaverse. Everyone's talking about that.
And for good reason. It's potentially the next evolution of the internet. And Unity is right at the forefront of that movement.
So we've got Palantir with their big data and AI, and Unity shaping the metaverse. Any others on your radar?
Definitely. In healthcare, there's Teladoc Health. They're all about virtual healthcare services, connecting patients with doctors online.
Oh yeah, telemedicine. That's been taken off lately.
It has, and the pandemic really accelerated its adoption. Teladoc is well-positioned to benefit from that trend.
Makes sense. It's just so convenient and often more affordable.
Right, and it has a potential to reach people in areas where access to healthcare is limited.
I can see the appeal. So we've got these fascinating individual companies, but how does understanding them help us evaluate QDTE as a whole?
Good question. By looking at these companies, we can gauge the overall growth potential of the Innovation 100 Index and, in turn, QDTE.
So it's not enough to just focus on QDTE's strategy and that high yield.
Not at all. You need to understand what's driving that yield, which means understanding the companies, their industries, their potential for growth.
It all comes back to the fundamentals.
Always does. But before we jump into the risks and rewards of actually investing in QDTE, there's one more thing about the Innovation 100 Index that's important to mention.
Ooh, what's that?
It's a relatively new index. It was launched just a few years ago in 2021. That means we don't have a long track record to analyze.
Ah, so less historical data to work with.
Exactly. So while the future looks promising, we need to be a bit cautious about extrapolating past performance into the future.
Good point. They say past performance is not indicative of future results.
Precisely.
Okay, so we've dug into how QDTE works, looked at the companies in the Innovation 100 Index, and now it's time to talk about the bottom line.
The risks and rewards of actually investing in this ETF.
Right. It's all well and good to understand the strategy, but what are the potential downsides?
Excellent point. We can't just get caught up in the excitement of innovation and high yield.
Speaking of high yield, let's talk about that 38.90% distribution rate.
Ah, yes, the big question.
We've hinted that it might be too good to be true.
And a big part of that comes down to return of capital.
Okay, can you unpack that for us? What does that even mean?
Well, it means that a chunk of those distributions might actually be coming from your initial investment, not pure profit.
So it's like getting a refund instead of a dividend.
Kind of. It's not necessarily bad. It can actually lower your tax burden in some cases.
Okay, that's good, I guess.
But it also means the share price might not go up as much as you'd expect, even with those big distributions.
So it's not all free money, as tempting as that sounds.
Definitely not. And then there's the whole zero DTE options thing. Selling those every day seems pretty risky to me.
Yeah, that's what I was thinking. What if the market suddenly tanks?
Well, those zero DTE options are super sensitive to market swings.
So in a volatile market.
Those premiums could shrink, and that could affect their ability to keep up those high distributions.
And if the market really nosedives.
Those options could become practically worthless.
Ouch. So QDTE wouldn't be a good choice in a bear market.
It would definitely face some serious challenges. It's designed for a specific market environment, one where things are relatively stable or moving upwards.
Okay, so that's something to keep in mind. High potential return, but also high potential risk.
Exactly. And we can't forget about those fees. Almost 1% is pretty steep for an ETF.
Right. It's easy to overlook those fees, but they add up over time.
They do. And then there's the active management aspect.
Oh yeah, we haven't really talked about that. Does that add to the risk?
It can, because it means the ETF's performance is heavily dependent on the manager's decisions.
So there's a human element involved.
Yeah,
Which means there's always a chance for error.
exactly. Even the best managers can make mistakes.
Hmm.
And no one can predict the future perfectly.
Right, it's not a foolproof system.
Definitely not.
Yeah.
So yeah, QDTE is a pretty complex investment. It requires a good understanding of the strategy and the risks involved.
Okay, so for someone listening who's intrigued by QDTE, what are the key questions they should be asking themselves?
First and foremost, what are your investment goals? Are you primarily after income, or are you also looking for long-term growth?
Right, because if it's growth you're after.
QDTE's covered call strategy might not be the best fit. It limits the upside potential.
Makes sense. What else should they consider?
Their risk tolerance. Can they handle the volatility of zero DTE options? Are they okay with potentially fluctuating distributions?
And those fees, can't forget about those.
Right, that 0.95% expense ratio needs to be factored into the equation.
It's all about finding investments that align with your goals and your comfort level.
Exactly, and it's crucial to do your homework. Don't just jump in blindly based on a flashy distribution rate.
Read the prospectus, understand the strategy, research the management team.
All of that. Knowledge is power, especially when it comes to investing.
Couldn't agree more. Okay, so we've talked a lot about the risks, but let's be fair. What about the potential rewards? Why would someone be drawn to QDTE in the first place?
Well, for income-focused investors, that potential for high distributions is a big draw.
Even if some of it is return of capital.
Right. It can still provide a steady stream of cash flow, which can be really valuable.
Especially these days when it's tough to find decent yields.
Exactly. And if you're bullish on innovation, if you believe these companies are going to keep disrupting their industries.
Then QDTE could be a way to ride that wave and collect income along the way.
That's the idea. It's like having your cake and eating it too, but with some added complexity and risk.
A good way to sum it up. So, final thoughts.
QDTE is a unique ETF, no doubt about it. It has the potential for high yield, but it's not a set it and forget it investment.
It requires a certain level of understanding and risk tolerance.
Absolutely. It's not for everyone.
Well said.
Yeah.
So to wrap up our deep dive today, we've explored QDTE, this intriguing ETF that uses a covered call strategy to generate income.
Focusing on the Innovation 100 Index, a basket of companies that are all about pushing boundaries.
But we've also highlighted the risks involved: return of capital, market volatility, those fees, and the inherent uncertainty of active management.
It's a lot to consider.
It is. So as always, we encourage everyone to do their own research, maybe even talk to a financial advisor before making any decisions.
Sound advice. Investing is a personal journey, and there's no one-size-fits-all approach.
That's right. We're here to provide information and insights, but the ultimate decision is yours.
And we hope we've equipped you with the knowledge to make informed choices.
Exactly. So that's a wrap on our deep dive into QDTE. We hope you found it insightful and maybe even a little bit entertaining.
We had fun exploring it, that's for sure.
We did. And we hope you'll join us again next time as we delve into another corner of the financial world.
Always exciting to see what we'll uncover next.
Absolutely. Until then, keep learning, keep exploring, and keep diving deep.